Hi, I'm Alex. I'm your Chegg tutor for this section in finance called arbitrage. Look at the definition. It's the practice of simultaneously purchasing and selling securities in two separate financial markets in order to profit from the price differences between them. Now, I put financial in square brackets because you could do it in non-financial markets as well, but normally we worry about the financial markets because of the issue of selling at the same time, buying and selling at the same time. So let's look what normally happens in the marketplace. So the blue line here represents the price of security, like a stock, and time is going towards the right. So typically what would happen is that you would buy at the first event, the stock would hopefully rise, then you would sell it so that you could buy low and sell high to make a profit. And in between here, you own the stock. So it's typically what this is called is going long, and this is the way most people hold securities in the marketplace. But you don't have to do that. You can do it in the reverse direction, sell high and then buy low after the fact. So if a stock is going down, you could sell while the price is high, capture it again while the price is low, and you make the profit the same way when you unwind it. Now, in this particular case, you can't sell stocks you don't own, so you have to borrow them from a friendly broker who will lend you that stock. So the key here in arbitrage is that you want to combine the two in such a way that you can make money immediately without having to worry about the holding period in between. So the question is, how would you do that? Can you sell at the same time and buy at the same time? Well, if you think about it, if you were in, say, a fruit market, so there was two fruit markets, farmers markets, and you went and bought apples in one market, you could scoot over to the other market, and if the price is different, you could maybe sell the produce you bought in the first market to the second market and make money. Same applies with securities. So the example here is with IBM. It's traded on both the New York Stock Exchange, its primary exchange, and it's also traded on the London Stock Exchange. And here would be a case where the price is close. In New York, it's $147.32, and in London, $145.50. So in order to buy low and sell high, you would buy in London and you would sell in New York. And if you could do that without transaction costs, you would make a profit risk-free, because you're doing it exactly at the same time, so no risks involved, of $1.82 before any transaction costs. Now in practice, of course, if you were buying in London, you would have to buy in sterling or British pounds, and so you would need to include an exchange rate, which is going to incur more costs. But in essence, you can do the same thing. All right. So what would we do in terms of different markets? Well, the other thing we can do is not only just between two physical markets in the same instrument, stocks in London and New York, but you can also do it between different security types. For example, we could sell stocks and buy futures, or buy futures and sell a combination of different options to cover it. Now, futures are a contract to guarantee a delivery or produce of the underlying security over time. And so if you were buying stocks, which is essentially the spot price, you would have to hold those until the futures expires. You could do something similar with options and futures. Options, if you buy a call option and you sell a put option at the same time, that creates what's known as a synthetic future, and then you can use that to trade against the real futures. Now this is way beyond the scope of this particular section, but it's just there for you to know that this is the sort of thing that can be done. Now, back in the 1980s, what was very popular amongst the big investment banks was something called index arbitrage. In this particular case, you knew what the stocks were and you knew what the price of the index was, say the Dow Jones Industrial Index. So floor traders could, in principle, when the pricing was favorable, buy or sell the individual stocks that made up the Dow Jones Index against the futures index for the Dow Jones Index. Now, interestingly enough, back in those days, in the 80s, the New York Stock Exchange was an open trading floor, and you would see the floor traders run to the market-making booths when they were given the instructions from the head office to go make the trade. So this was quite profitable for a while until other people got wise to that, and then their own traders would notice when somebody was going to run to a market maker and run in front of them to be able to do a transaction in front of the investment bank's traders. This is known as front running and is now the term that's used when you try to literally get in front of a known trade to try and profit from the fact that if somebody buys, the price will go up marginally between the trades, between the beginning and the end of a trade. So let's see if you understood what's going on, and we'll involve now transaction costs. So the biggest transaction cost that you have to worry about is the difference between what you can buy something at and what you can sell it at. And in the marketplace, this is known as bid, the price that you can sell, and the ask price is the price that you can buy it at. So let's look at two markets for the security. In market A, you can sell your security for 113, but you have to buy it at 116. So clearly, you can't buy it and then sell it at a profit, right? You're going to make a loss of 3. Now in market B, you can sell at 115 and buy it at 118. So can you arbitrage that? Well, the answer is no, because what you would have to do is you would want to buy at the lowest price on the market, which on average is going to be at market A, and you'd have to buy at 116, the ask price. But in market B, you'd have to sell that security, but you'd have to sell it at 115, so you would make a loss of 1, so you won't make any money in this particular case. On the other hand, let's look at this market. In this case, the bid price is 113 and the ask is 116. But now in market B, the bid price has risen to 118 and the ask price to 120. So in this case, you could buy at 116 in market A and sell at 118 in market B, and you make a profit of 2. Now arbitrage is actually much bigger than this. There is something else called risk arbitrage, where arbitrageurs try to estimate the difference in pricing based on the potential of a merger succeeding or not. And there are other forms of arbitrage. And essentially hedge funds are too, at least the original form of hedge funds, were essentially trying a sort of arbitrage where they were trying to immediately buy and sell securities at the same price. But in this particular case, not true arbitrage, because the prices would come into alignment over some period of time. So it wasn't true arbitrage because it wasn't risk-free and it wasn't immediate. But this, what we've covered here in essence, is the basics of arbitrage, the idea that you can, in some circumstances, buy in different markets securities and sell them against themselves so that you can make an instantaneous profit. Now this has become so popular that in practice it's almost impossible to do arbitrage, and it's now mostly gone back to the high frequency trading, where they're essentially arbitraging prices in microseconds, and they also do a lot of front running as well in order to get in front of what they see as trades from the institutions. So that's it for arbitrage on this section. I hope you've enjoyed it.